You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, friends, today we have a very special friend of mine on the show. We have Jerome Myers. I think many of you would recognize his name. He's all over the place out there. This guy is just a giver at heart, super intelligent, founder of the Dreamcatcher program and the I Took the Red Pill podcast, as well as I believe there's a Dreamcatcher podcast. I don't know. He's got so many things going on, but super brilliant dude. He's been a friend of Quattro for a long time. Funny enough, he and I just met a month and a half ago personally, and we agreed to do a show or two together. Jerome and I are going to get on here. We're going to talk a little bit about where we see our investment theses here in the world today. Are we still doing multifamily? Are we doing other stuff? You're going to find out. But before you do, if you get any value out of this episode or anything else we do here at Real Estate Runway, please leave us that 5-star review, thoughtful comment. Pay it forward, folks. This is the only way that more people like you will hear about this show is reviews, likes, subscribes, all that kind of stuff wherever you're watching this. So pay it forward, help someone else find the show. And I so appreciate you for it. If you want to come on the show, you can apply at thequattroway.com/podcast. I would love to have you on. These conversations are just worth their weight in gold, and I love having them so much. And if you want to send us an email, maybe recommend a topic, anything of that sort, you can leave it in the comments or email us at podcast@thequattroway.com, and we would love to respond to you there. Folks, we are a full-service real estate investing firm here at QUATTRO Capital. If you want to apply to work with us or reach out and build a relationship, see if we might be a good fit for one another, reach out to us at thequattroway.com/invest. And as of this recording, we do have a pretty slick new investor experience we just rolled out. I'm super excited for. You'll probably hear the advertisement for that platform later in this show. So without further ado, let's get right into the episode for today. Here we go. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. This is your captain speaking, taking off for a great lesson in real estate today. Jerome is laughing. I told him not to. He's doing it anyway. But guess what? We have my friend Jerome Myers on the call today. Jerome, what's up, my man? Long time no see.
Man, look, Chad, it's been a long time coming. I heard about you probably 3 years before I ever saw you on LinkedIn, and then I actually got to meet you in person this year. So it's amazing how somebody's reputation can precede them. Maurice Philogene had all positive things to say about you. So just know you're in good company, my friend.
Yeah, man, I appreciate you so much. And we have actually one of our team members is actually a member of all your mastermind stuff. So yeah, we have a ton of interwoven circles, and it's a shame, but it's funny that you and I just met like a month and a half ago. But yeah, man, love everything you're doing. Happy to have you on the show today. And just for those who may be living under a rock and not heard the name Jerome Myers, would you just real quickly kind of give me a little synopsis on yourself, and do mention the podcast and programs you have as well up front? Because if you guys haven't heard of this guy, you need to. So let's go into that.
You're going to make this hard for me. Yeah. Who am I? It's funny. I'm a guy who dropped out of corporate America back in 2016. I just finished 2-year stint where we went from 0 to $20 million in revenue. The first year we had 175 folks on my team. End of the year, December 24th, I get a phone call from the guy that I reported into. And he said, "Hey man, I made a decision. We're going to cut half the staff." I was like, that's not the right answer. You and I, we've been going back and forth about this thing. That's not what we need to do. We're going to need them. We're going to grow some more next year. He said, "Look, man, I'm not calling to debate and negotiate with you. That's what we're going to do." And I pretty stubborn, Chad. So I kept going back at him. And he said, "Look, man, it's 4:59 on Christmas Eve. I'm going to go spend the rest of the year with my family. I'll talk to you in the new year." And the phone disconnected, and it something in me just started to die and shrivel. Man, this isn't right. Like, these people had one lady on the team who didn't go with her husband on the next deployment, had other people on the team who decided not to take promotions and go to bigger jobs so that they could align with this mission and do something that had never been done before. And somebody who I talked to every other week and saw once a quarter was able to make a phone call and tell me what I was going to do with my team. And I was like, I don't ever want to do this again. But we put Humpty Dumpty back together again, Chad, made another run, another $20 million, another 30% of profit margins. And I knew that I didn't want to ever get that phone call again. I'll never forget standing in front of my team the Tuesday before Thanksgiving and saying, hey, don't spend all your money on Black Friday. I don't know what'll happen between now and the end of the year. I felt all my leadership credibility just ooze out on the floor. So I was carrying somebody else's message, somebody else's mandate. And I was like, man, I can't do this anymore. So I dropped out, tried to buy my first apartment complex. That failed. Walked into a bunch of different banks. I think it was 10 of them. They all told me no, I wasn't qualified. And I said, I'm an engineer and I got Six Sigma certification. And I kept running down the list. They said, yeah, but have you ever bought something of similar size and executed the business plan that you have laid out in this beautiful 54-page presentation you brought to us? I said, no, I don't. And he said, you need to go find a partner. And I didn't know anybody. I knew one millionaire at the time. And I was just shocked that somebody would turn me away. Had some money in the bank, had an 800 credit score. I built a $20 million business. And you're telling me I can't buy $1 million or $1.5 million building and execute a business plan and figure out how to get people to live in it. And so I started fixing and flipping. And then, and only then, did I meet a guy who was interested in buying the same property that I was interested in buying 6 or 7 months earlier. And we eventually partnered on the deal, had a couple of other folks who came in, and the 5 of us bought this first deal for $1.3 million. And we disposed of that last year, Chad. And I think we sold that for 3.6 or something. And it worked out really well, about a 60-month turnaround. And so a lot of people will say, hey, you got to buy the biggest, you got to buy 100 units or more. But we've been able to buy smaller properties and make what some people would consider astronomical returns, considering we're not buying like markets like Salt Lake City or Dallas, Texas, where we saw a big run up. We're buying North Carolina, Greensboro specifically, and Richmond, Virginia. So we've done some things that were counter to the market. We've joint ventured instead of syndicating. And we've enjoyed the ride over the past few years, man. It's been a really educational experience for us. The School of Hard Knocks wasn't kind at all times, but we've been able to weather the storms and get to some exits, which have made us really happy.
Man, that School of Hard Knocks, I call it scars and stripes. We've all got them at some point. And man, my heart kind of just, it shuddered right there when you were telling me the call you got on Christmas Eve. It's like my experience with corporate. I had a good experience with corporate. I went through, I made the company a lot of money, had rapid success, all that. But at the end of the day, you're just a number. As soon as you are not useful to the company, you will be replaced, obsolete, one of the two. And that's important for anyone who works for a company or is in a similar position to what Jerome is, that just know that you're not secure. You're only ever 2 weeks away from change. Able to say change. We'll use that word instead of termination. Oh, wow, man. Before we get into the show though, just tell me about Dream Catchers a little bit and about some of your programs you have as well. As I want to make sure the listeners know who we're talking with here.
Yeah, I try to slip on past that one. And so Dream Catchers is a podcast where we interview people who have exited the matrix. It could be leaving corporate, because there's 8 different exits that we've identified. One is exiting corporate. The one that most people talk about is the 8-figure exit, which is exit number 6. And that's where you build up a company and you sell it for a lot of money and you feel like you won the lottery and you don't ever have to work again. And then on the backside of that, a lot of people buy portfolios. And so what Chad and the folks at Quattro have been doing is they've been buying businesses. They just happen to have real estate attached to them. You build a big old portfolio, a whole lot of cash flow coming in, and then you can exit that thing and in the end get a bigger payday than you would if you built up a single company and sold that. And so we help people figure out how to do those. And then the next level to that, once you become what we consider a magnet in the industry, is the philanthropic angle, which is exit 8, where you build up a foundation and it's endowed. So you don't have to go on the fundraising circuit every year. You figured out how to fund it so that continues to live on past you. There's 8 different exits. A lot of people talk about the first one, which is leaving corporate, or the 6th one, which is getting rid of your company. But we bring people in on the podcast and we have discussions about them in that journey, because I think success leaves clues. And our goal is to help as many people as possible find their freedom, exit the matrix. And if we can get people who have done it to tell their story, and it's not just the HGTV version where everything is all rainbows and unicorns. It is the good, the bad, and the ugly with the expectation that you can learn more from the bad and the ugly than you ever will from the good. And so we do that. We work with some folks who want individualized experience with help with their exits in a number of different fashions. We've got a mastermind. We do some one-on-one work. And the goal there is just to expedite the process. We're trying to collapse timeframes, and we're trying to eliminate some of the unnecessary scars or mistakes that people have when they're early in the process. If you can avoid a level 1 mistake and save that for a level 8 mistake, I think you will be in a much better position and able to bounce back because you didn't ruin whatever was going on before it actually got started.
See, it's one thing to do a shameless plug, but what you guys don't know about Jerome is he's the most humble human being on the world. And so when I force him to come back on the mic and do the shameless plug, it's like an extra unshameless plug. So anyway, check it out. It's cool stuff, man. You're doing good stuff in the world. And by the way, for those of you who are watching or watchers of HGTV, it does not cost $1,500 to put a steel beam up and remove a wall in a house. I'm just going to tell you that right now. So don't budget based on, no, ever. It's so much more. So don't ever budget based on HGTV, rainbows and unicorns. So anyway, Jerome, let's get into the podcast material for today. And you and I were kind of bantering at the beginning of the episode. And I never know what I'm going to talk about on these things. I'd like to just get on and see what's up, what's best to talk about. But both of our eyes kind of lit up when we started trading notes on where are we looking for yield today? Is multifamily the right thing to go into now? Is retail, is office? Like, what is going on in the world? And is it even real estate right now? You mentioned portfolios of businesses. I've been entertaining some of that lately, but what I'd love to just kind of lob one up to start off is, where are you looking today? Are you still putting together multifamily deals? Are you looking elsewhere for yield? Are you sitting on your hands and surfing right now? Or what's going on in your life?
Yeah. So where are we looking? Well, we're looking at things that aren't capital intensive. I think capital intensive, high debt or high interest rates are the things, if we go into a deep, dark recession. I don't know if we're in a recession or we're not in a recession. I don't know what the Fed's doing with inflation or if we don't have inflation. I don't know any of that, chat. But what I do know is this. If you get in a space and buyers are uncertain and you've got debt service and they stop buying your service, then there's only one place that debt service goes to get paid, and it's out your pocket. And so I think it's extremely important that people who are looking to place capital are looking for places where there isn't a heavy debt service burden. And so what we're seeing, I've got a property that's due for renewal, refinancing, whatever you want to call it. The debt's coming to maturity, and the property is levered less than 40%. And so when I asked the lender if they'd be interested in doing a cash out refi with me, they told me they were not interested in placing any more debt on the property. And it infuriated me because I don't think it's practical to lever something at 40% and expect to get a reasonable cash on cash return. Now, at the end of the day, we've got a great cost basis. So this actually will work out in our favor. But I think people struggle when they're going into deals right now to buy stuff. And so if you are going to buy real estate, I think the most important thing that people can consider is cost basis. Do we actually know what the right cost of basis is? I think there's still some price discovery going on. Should we be reducing prices as sellers if interest rates are higher? I'm not. I'm increasing my price, but I bought things in a different period. Everything that we bought was pre-COVID, and we operated it through COVID, and we did pretty well during that. And so having multiple years of strong financials, I think, allows us to market our properties at a premium. But I do know that there's a lot of people who bought things right before COVID or in COVID, and they didn't fare as well. And so I think those folks, especially if they did bridge debt, are in a position where they're going to have to divest those properties if they can't get refied to people at a cost basis that will allow them to hit their cash on cash return targets, that will allow them to actually make money on appreciation if they're able to figure out how to operate the deal with more favorable conditions. Because the great thing for, I think, any operator right now is rents have gone up. If you bought something in 2020, 2021, unless your property manager is asleep, you should be charging more in rent for that same unit. Would you agree with that? Are you guys seeing that in your markets? I know you guys are all Southeast, and it's pretty impressive. I mean, you even got some stuff out in Texas now.
Yeah, we're pretty spread out. But yeah, income hasn't been the issue. Income is very strong. And like you said, unless you're asleep, you moved income pretty well. I'd say that the bigger challenge that, especially in Texas has additional challenges, but the challenge has been the expense load in a lot of these properties. So just think taxes and insurance. So states where they're going after taxes, and states that have been prone to a lot of natural disaster, those expense loads have risen a lot faster. But still, if you have a good asset and you've performed at all, your P&L probably looks pretty good. But to your point, it all depends. If you had a good basis, I've got stuff we bought at market, and I've got stuff we bought at 40 cents on the dollar. And the stuff we were refinancing, to your point, where it was 40 cents on the dollar, yeah, okay, it sucks that rates are at 6.5%, but we're still okay. But there are, of course, some projects that people have that are not in that case. And so I think that's where we're going to see some trouble. And man, the interesting thing is, like you said, the fundamentals haven't really changed. Okay, so fair. You got occupancy has dropped 2 basis points, or sorry, 2%. Okay,
Woo-hoo.
We've absorbed some stuff. We're still mid-90s. So yeah, it's down a little bit, but not enough to have this massive crash. Now, maturities, we've had this big impending gloom and doom, and every writer under the face of the earth has been writing about this, saying, oh my gosh, CRE maturity is going to crush us. It's going to be the biggest 2008 you've ever seen. And you know what happened? It's almost like the lenders learned their lesson from 2008. They're restructuring loans, ones that can't be paid back. They're just like, oh, we'll add a year, or we'll restructure it somehow, or maybe you pay it down a little bit if you were super highly leveraged. I was actually telling a mutual friend of ours this morning, the price discovery is still happening, and it's gradually creeping up the longer that rates stay high. And I think there's going to be some trades that we'll just call them reluctant trades. I don't think it's a forced trade, but people are like, oh, I'll just sell it and get out of this or whatever. But I still think they're going to keep crawling up until the point which the rates reverse and go the other way, which they will. They always do. And then it'll probably meet back in the middle, close that gap of buyer and seller demand, and then we'll probably see some compressing cap rates again. But to your point, the frustrating thing is, if you're trying to buy right now, prices and debt don't align. Yeah, and so you have to minimize your capital intensiveness, right? Which means you're not doing, if you're doing bridge debt right now, stop, because you're going to be upside down in a heartbeat. And oh, by the way, I can tell you some stories about lenders that are not funding. I have properties that are in perfect shape, doing great. And because technically we don't meet a covenant of DSCR because the index went up, even though I've got a rate cap, they're not funding. So we're having to fund out of pocket. So you think bridge debt's going to be clean right now? It's not, if you even think you can afford it. But to your point, doing projects that are not super capital intensive and able to support, we'll say, modest leverage debt, you can refinance in a couple of years. But yeah, you're still getting a good basis right now if you're buying things with good fundamentals, I think.
Yeah. And a lot of people ignore the past performance. I remember going in cocky and arrogant and believing that I knew more than the person who owned the property for the 20 years prior to me showing up and saying I was an investor. And I quickly found out that I didn't know as much as I thought I knew. And my property manager wasn't as smart as I thought they were. And when we were humble and we took a step back and we looked at things, we saw the world in a totally different way. And so it's great when people put their marketing things together and tell people they're going to make X or they're going to make Y. It's another thing when you actually peel back the layers and truly understand the business plan and what has to go right in order for them to be successful at that business plan. And I don't think most people actually do the due diligence to understand what it's going to take in order for the people to be successful at the deal that they're putting together. And so if you are an investor, because I know there's some passive investors out there who is deciding what deal to invest in based on the IRR, or the cash on cash, stop and look at what the business plan actually is and truly begin to understand how the deal is underwritten so that you can make a decision. Because you're supposed to be sophisticated, right? You're supposed to understand how these things work so that you can make a decision on whether or not it's likely that they're going to have the success that they need to have. And I just see people throwing cash into deals when the cost basis just makes absolutely no sense. And so you're paying too much for the base unit. Then you're throwing $25,000 per unit on top of that into the renovation to get a premium of $200 on the rent. That math just never works in the long term. You're counting on appreciation. You're counting on cap rate compression, and those things will come back and bite you.
Let's give a little buyer's formula real quick. So just because you and I have put together a ton of deals, we've invested in a ton of deals, both. I think if just talking directly to you passive investors out there, and even you operators who are putting things together, listen to me clearly. Listen to us here, because I can make a spreadsheet say whatever I want it to say. I can make that
More
pretty
lies
picture.
in Excel than in Word. It's a beautiful thing.
I love that. I can make any presentation show 20% annualized rate of return and 6% cash on cash return. But the underlying assumptions, that's what you got to look at. So example, look at the debt. Is the debt a highly leveraged bridge loan with pref equity in front of you and all that kind of stuff with a refinance that's assuming rates go down 100 basis points to achieve those numbers? That's a lot that has to go right. Is the cap rate going up or down or flat? All those things add risk. Is just look at the lift. Are they saying they're going to take something that is in the hood and they're going to go charge Class A rates on it, or something in between? Just think about it. This funniest thing, and I can actually say this. You'll only ever hear me say this once, folks, because people say this to me all the time and I never use it myself. But I was once a rocket scientist, so I can say this shit is not rocket science, okay? People joke with me all the time. No, I can't say that. But I'm really going to say it right now, because when you just boil down and write down in words what a pro forma is, real estate ain't hard. There's a lot of common sense to it. You can look at numbers and data and all that kind of stuff and put it out. But man, like I can show you 4 pro formas that say the same exact IRR. And if you just put that common sense in there, man, you're going to be able to pick out the risk pretty quick. Oh, that clearly is the lower risk item. Think about risk adjusted return. You know what I'm saying? It's wild.
It's funny, Chad. I've had a lot of people come to me asking for help. They'll go through their multifamily investing education program, and then they get out and they're like, I don't know how to underwrite a deal. I don't actually know how to operate this property, but I know that everybody that I'm competing with has 15 to 20% IRR and a cash on cash return. You put it at 6, but in the past it was somewhere between 9 and 12%, right? That's what they were going for. And
It's in the last 10 years, no doubt.
it absolutely has, right? But people are like, how can I make this deal work? And you make the deal work by paying less for it or by not putting as much in renovations. But then people will turn around and say, oh, I'm going to renovate these units for $3,500 a unit or $5,000 a unit. It's like, okay, but you're not going to get through your budget. You're going to blow it in the first half. And now you've got to sell it. And yeah, people in the past have said, oh yeah, we're leaving meat on the bones. That's why we're not renovating the rest of the units.
No, you ran out of money.
But they ran out of money. Then if you aren't adjusting for your taxes, you better adjust for your taxes. If you don't have an insurance quote before you take your deal to the raise, you better have an insurance quote, because if you can't bind the insurance and you get surprised with that one, and I've made mistakes on both, right? I'll never forget my first deal. I bought the deal. I put taxes at $1,000. None of my partners saw it. The lender never saw it. Taxes were $10,000, Chad, but I had it at $1,000. You can't get that back. I can't earn, like, it goes straight against the bottom line. That kills NOI right off the bat. If you aren't certain about your underwriting, you better get somebody to look over your shoulder. And it's probably not your multifamily mentor, because most of them don't really underwrite that well. They're really good at selling you the dream of you're going to be retired in a year or after you do 2 deals. But I struggle, man, because there's so many people out there who have been convinced that there's a shortcut by going into this business. And being an operator of real estate, especially commercial real estate, you better be good. And people who come in and think it's a walk in the park, I think you're at times being very disrespectful to the people who are actually making real business decisions with their own money and not money they raise from a bunch of other people like it's a tech startup to get deals done. What would you do? And this is for the passives out there. All right, so you've run out of money in your project, and the operator's got a decision to make. They can do a capital call, or they can pay the mortgage this month with their own money. If your operator isn't in a position where they could write the check to pay the mortgage, you better think twice about sending your money to the deal. Because real estate, and we talked about this in a different way, but I'll bring it to this place. Really, as long as you don't have to sell the real estate, you can always come out and make money in the deal. But if you run out of money and you have to sell the deal, people can force you to sell it at a loss. But you need somebody on the team, and maybe it doesn't have to be the person that put the deal together, but somebody on the team who believes in the business plan so much that they're willing to put their own capital up before they go and ask other people for capital. That's my personal belief. And I've talked to a lot of operators. We have a podcast called Multifamily Missteps, and I don't know that I've talked to any operator with a significant portfolio who hasn't at some point had to feed a property or write a check to pay operating shortfall in some way, whether it's debt service or some feeding a rehab budget or something else like that. So for the people who are perfect out there, because I know there are a bunch of people who didn't take any losses when we were in COVID, like everybody paid on time every time. And I know that you've never underestimated your rehab budget. And I know that there's always been enough operating cash flow to pay your debt service every single month. When the payment came due, no, we're not talking to them because they're perfect. But for the rest of us that are out here, I encourage you to have a conversation about whoever you're investing with and understand whether or not they've got the grit, whether they got the intestinal fortitude to go through that stuff, because that's going to be the person that makes sure that your deal doesn't fail. The person who's only had rainbow and sunshine, unicorns, when adversity hits, I'm not sure that they're going to grit up for you.
That's a great walk right there. And for the record, I'm one of those people who have had to write checks into the property. You didn't know what I was going to say, did you? I'm not the perfect guy. Now, we have had to write checks into property.
I believe in you.
Know? Yeah. And that's the interesting thing, because those are the questions you need to be asking people, right? And I can get convinced if someone's not investing in the deal with me, but I got to know that they're liquid enough to handle the stuff. If they have the track record and all that, because that's bigger to me. It's okay. That's great if you want to put $1 million in the deal with me, but if that's all the money you have and now you're just as broke as I am after investing, that's not good either. So you got to make sure that the company you're investing with or the person has the ability, because it's only a matter of time if you're doing multiple deals before you get one wrong, or you have a COVID, or you have a rate hike due to inflation or something that messes with things. And I think you're so wise to say that's capital calls it's not always a cuss word. Capital call is a usual thing. If you're an institutional player, it's like someone with think about Blackstone, right? If they're going to invest $100 million into fund A, they're not going to put $100 million on day one. They're going to say, I'm going to hold my money and make money on it. I'll put a deposit, and then you capital call me when you're ready to deploy it into an asset. That's great. A lot of big funds do that. With people like you and me who are on the phone, and everyone listening here, we don't have unlimited pockets. And so if we muster up 100 or 50 or 200 or whatever the number is, you probably don't have an extra 50 laying around to do a capital call. And so you really got to protect yourself on that and make sure that, like you said, if things don't go according to plan, are you exposed or is it covered?
Chad, there's going to be something that isn't according to plan. I don't care how good you are. The only thing that I know about my model is that it's wrong. It won't be the numbers that I have on the paper. That's all that I know. Now, if I'm conservative enough, then the income number will be bigger. The expense number will be lower, but it's not going to be the numbers that I put on the paper. And so it's really interesting to me when I see people put stuff with a decimal point behind it, and they got the income down to 8932 instead of zeros. Like, it's really interesting when people get that precise, because I know that number's not right. It's not going to be that number.
Yeah, that's fair. I think you're absolutely right there. And you're an engineer too at some point. All models are wrong and some models are useful. I used to do a nerd alert coming through, right? I told you I used to be a rocket scientist. I used to do computational fluid dynamics, CFD models. It was like the pretty colorful models you see with air going over stuff. I used to spend so much time trying to get it exactly right. My mentor came by and said, like, dude, he's like, you know what we're going to do to validate this? We're going to go make a piece of metal. We're going to light it on fire. We're going to throw 3 sensor probes on it. And we're going to see if anything on your model is close to it. We're going to take that as an acceptance. So if you're within 10%, you're good. But you can't predict this thing. It's a good guiding light. It's a good way to think about the thing and get your thoughts formulated. But you're absolutely right. So, well, final thought before we go to the Quattro questions. I think both of us are kind of the general consensus that multifamily and really real estate in general, it's still all good to buy as long as you're watching your basis and maybe not going gangbusters on bridge debt that's going to mature soon right now. But any closing thoughts on where you're looking for yield and what you're focusing on today?
Yeah, you got to buy stuff that's performing now more than ever. If you're buying something that's really broken and you don't have really deep pockets, you're setting yourself up for a lot of pain. And so that's my final thought. It's find the things that are already working and you see some potential upside. You see some inefficiency in the operation, not so much in the property not being in great shape, because that stuff is getting really expensive and contractors seem to be shrinking. There seems to be a consolidation of the contractors that are available in the market.
Yeah, that's good advice, Jerome. All right, jumping over to the Quattro questions. Number 1, what is your superpower, life or business, and how does it serve you?
Yeah, man, as squishy or woo-woo as it'll sound, I'm an empath. And so I can tell what's going on with the person without them telling me anything. And I do the courtesy of asking, are you okay? It's a very different question than what's wrong with you or what's up, what's going on, but are you okay? And from time to time, people will actually engage with me and share if they're okay or not. And that is my small act of kindness for the world, because I know many of us, especially when you're a high achiever, you don't have anybody asking if you're okay. They just want to ask you what you can do for them. And I think we could be a lot more human if we spent a little more time asking people if they were okay and giving them an opportunity to share.
I love that, Jerome. It's almost like the go-giver mindset a little bit, but I love that. So let's flip the coin over. What is your biggest failure to date, and what'd you learn from it? Could be life or business again.
Oh, man. I've got so many failures. Which one do you pick? I think my biggest failure was going through my divorce as a plaintiff and losing every point of the case. Every point of the case.
Wow. So what did you learn from it? What did it teach you?
So this is really interesting because I had an instance come up last week where I had a contractor charge me an exorbitant amount of money, and we paid it. We probably shouldn't have paid it, but we paid it anyway. He didn't have any recourse. We'd already sold the property. And if you've ever seen those movies where there's a knight and they won the battle, right? And the king is there and they got the option of beheading the person or not. And there's something in me that always cheered for the guy that didn't cut the other person's head off. And that was one of those moments for me, right? And I think the same thing happened in that. It's the stronger person doesn't always have to wield their power. And the ability to pick and choose when you wield your power, when you demonstrate your strength is, I think, something that has been attacked, right? I think masculinity is something that's been attacked a lot here over the last year or so. And I just worry. It's a struggle for me of, are we attacking masculinity because people have abused power in the past? Are we attacking masculinity because we're scared for people to have the power and we're concerned about being out of control of when they decide to exert their will? And for people like me who I just need you to know that I could have done that. I don't have to do it. I just need you to know that I could have done it, because then you know that I've extended grace to you. I think grace is something that is really underrated. It's underutilized, and it would make the world so much better if more of us demonstrated grace in our interaction with other people. I think it's one of the greatest expressions of love.
That's an incredible lesson coming out of that. And I hadn't really ever thought of it that way. Was that why we're challenging masculinity in the world? Wow. Thank you for that, Jerome. Last two questions. Here at Quattro, and I think you mentioned it in your intro as well, philanthropy is one of our 4 pillars. We love putting love back in the world, putting money back in the world, times, talents, treasures. I love to give our guests an opportunity to speak their philanthropic heart. And we actually have had reported sightings of people donating to that on your behalf after the show. So I'd love to know what that is for you. And if there's any link, we can include it in the show notes.
Yeah. So back in 2007, we made a donation to my alma mater, and it allowed us to create a full engineering scholarship for students at North Carolina Agricultural and Technical State University. And now our goal is to take it from 1 student to 2. And so that full ride includes room, books, food, the whole shebang. And we don't give it to freshmen. We give it to sophomores who've got a 3.2 GPA or greater, because we feel like they've proven that they've actually got the chops to finish, and it's renewable, so that they don't end up flunking out or failing out. And the whole goal there is just to allow more people to go through and get their education without the student loan debt, which then I think will help people move to creating financial independence quicker, which then my hope is they will take their prosperity and then be able to reinvest it to continue to perpetuate this cycle of creating opportunities for other people. I was fortunate enough to go to college and graduate debt free, and my parents didn't have to pay for it, partially because of my father's military service, partially because of my academic merit. But we want to help create those opportunities for other people. And if somebody wants to go over to ncat.edu/give, and if you search Myers, you'll see our endowed scholarship there.
I love that. I love that. And folks, as usual, scroll down in the show notes. You'll find that link in your show notes for your clicking pleasure, whatever you're watching this on. And Jerome, last question. You have a white paper, I think, that's available for our audience today. What is that? Where can they find it? Tell me a little more about that.
Yeah, man, there's a couple of different places we could go. I think for this audience, the best thing to offer to them would be we're going to switch the white paper out. We're going to give them a book, man. It's what do you do in the first 90 days? And so you take over a property, whether you're the operator or you're an investor, you take over the property in the first 90 days. What are the things that should happen? And so if they hop over to jeromemyers.co/book, they'll be able to download that and get a download of what we believe should happen in the first 90 days. So you can successfully take over the property and get off to a great start.
Fantastic. Jerome, thank you for coming on the show, giving us some of your super valuable time. Audience, I hope you enjoyed this discussion. Just a little bit of sharing what's inside the two of our heads and what we're doing today. And hope to have you back on soon, brother.
Thank you, Chad. Good to see you.
Man, I love having that guy on the show. He was so much fun to talk to. So I hope you guys enjoyed the episode here with Jerome today. Just saw a little bit of his heart and how we enjoy working together and talking about this stuff. If you got any joy out of the show, please leave us that 5-star review, thoughtful comment, subscribe on YouTube, wherever you're listening to this thing at. Swipe right if we're on Tinder. Just kidding. I don't know where all we are, but anything you're watching this on, subscribe. That is the only way to pay it forward and make sure someone else just like you gets the same value you just got out of the show. So love putting out this free content because it gets the messages out in this world to help people just like you. So last little bit, we're on all the socials. If you want to check us out, any of the managing partners' names from the QuattroWay.com, you can visit us there. You'll see all of our profiles, or Team Quattro Capital, one word, no special characters on all the socials. We'd love to engage with you there. And folks, just a reminder, if you want to be on the podcast, visit us at thequattroway.com/podcast to apply. And we would love to have a conversation with you if you are an active investor or a partner looking to do something fun in real estate. Visit us at thequattroway.com/invest, and we'll talk to you there. Without further ado, I'm going to end the show today. And folks, this has been another episode of the Real Estate Runway podcast. Until next time, over and out. Bye for now.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.